Good afternoon, everyone, and welcome to TradeStation. This is Michael Burke. I'm Vice President of Client Training here at TradeStation, and today is another edition of My Art of TradeStation. And today we're going to talk about understanding volatility for options traders. TradeStation has launched an exciting new website called Market Insights. This is done by my colleague David Russell, who writes the TradeStation blog. It's an incredible website of information on stocks and futures and options, what's going on in the market, unique opportunities. So if you get a chance, take a look at our new website, insights.tradestation.com. We have a great event coming up in Chicago next week, Friday, our Option Stars event. We have 6 incredible speakers. It's an all-day event at our office in Chicago. You can attend this event for free with our commission rebate program. So if you're going to be in the Chicago area or would like to come out, we have some great hotel rates as well on the website. Take a look at the Option Stars event. John Carter, Sarah Potter, AJ Monty, Sam Seiden, Price Headley, and Dan Sheridan. It's a great lineup. Lots of great speakers, lots of great surprises. We're going to do lunch and have a cocktail reception after, roundtable, options discussion at the end. So if you have a chance to attend this unique event, I think you'll find it incredibly worthwhile. The link to that event as well, there's a whole web page that talks about everything related to Options Stars in Chicago. And if you have a chance to attend, take a look at that website. Keep in mind that the following presentation is for educational purposes only. All of the symbols and trading ideas discussed are for educational purposes and are not necessarily recommendations. Active trading isn't suitable for everybody. Options trading, doubly so. Take a look at the characteristics and risks of standardized options document, and you can find additional disclosure information on the TradeStation website. Our agenda today is to talk about the different types of volatility, implied volatility and statistical volatility, and how they apply to your options trading. What's important about implied volatility and statistical volatility is we have to be able to measure it relative to historical values or relative to each other. And I'll show you some unique data and tools that I've created in TradeStation to help us do that. And when we can measure whether or not volatility is high or low relative to its historical values, we can scan for unique opportunities. So here's a graphic of how options are priced. And if you think about the option premium, there's a lot of moving pieces that eventually derive the price of an option. The intrinsic value on the left is the relationship between where the underlying asset is right now and the strike price of the option that you're looking at. But for most options, the biggest component of the option price is time value. How much time is remaining until expiration? And what is the volatility or risk of that underlying asset, which we measure as volatility. And we're going to measure that in a couple of different ways. There's also a couple of minor time value criteria, which is the risk-free interest rate, which has been very low for a long period of time. That's starting to creep up a little bit, and at some point here it may start affecting option prices a little bit more. And of course, the dividend of the underlying asset. As an options trader, it is incredibly important to understand when dividends are being paid and what that dividend cycle is for the underlying asset that you're trading. There's really 2 things as an options trader that I always focus on before I click the buy or sell button, and that is, first of all, where is the stock in the earnings cycle? When is the next earnings going to come out? And 2, if there's a dividend, when is that dividend going to be paid? So we're going to focus on that volatility component of the option premium today. So there's basically 2 types of volatility as options traders we need to focus on. In the old days, before computers were really so mainstream as they are today, the volatility that most options traders and floor traders looked at was this concept of statistical volatility, which was based on the underlying price movement of the underlying asset, in other words, the price of the stock. And basically we would calculate a standard deviation calculation usually over about 30 days. It might be a little bit longer depending on the life of the options trade that we were thinking about. But basically, we would calculate the standard deviation volatility, which would give us an estimation of implied volatility over a 30-day period. And that indicator is actually built into TradeStation. I'm going to show it to you here in a moment. And you can put that on the chart and see exactly what the statistical volatility of an underlying asset is. That's still an important value in comparing where the implied volatility for the options are compared to that statistical value. And we'll look at that indicator here in a little bit later. Implied volatility is the volatility implied in the price of the option. So you have traders and market makers trading all of the different options, and the options are priced real time throughout the day based on changes in volatility. If an option goes up or down, it's typically a factor of whether the underlying asset is moving up or down, or if there is more perceived risk in the market, volatility or less risk. Implied volatility for those options are going to go up or down and either increase or decrease the price of the option independent of just the underlying asset going up and down. So there's lots of, as we saw in the previous graphic, lots of different things happening throughout the day, moving pieces that are deriving that final option price that we look at in the option chain. Implied volatility in OptionStation can be calculated on a real-time basis for the entire chain. You can see that, or you can see it for individual options. For historical perspective, though, what we'll do is, especially in the major markets, what we'll do is we will take a subset of all the options, usually options that are around the money and options that are in the near months. We'll average those together into one number that we can use to compare whether volatility is high or low right now compared to historical values. A good example of this is VIX. VIX is the volatility index for the S&P 500 options. And basically that's calculated in real time by the CBOE, and it is a data stream that we can look at intraday and historically going back many years to see where the implied volatility of the options or a group of options for the S&P 500 have been historically. And that can be a great measuring tool for whether the options that we're looking at now are overpriced or underpriced. And that's a really important factor when we're going to make an options trade. So let's first look at statistical volatility really quickly here. This is the indicator that comes with TradeStation. It's called Volatility Standard Deviation, and we usually use a 30-bar look-back period. This is typically done on a daily chart, and we always usually compare historical volatility on daily bars for historical perspective, but this indicator could be used intraday. It just doesn't have the same analytical value as it does on a daily chart, so that we can compare VIX and other values. So this is a symbol of IBM, and you can see that statistical volatility, again, when we talk about volatility in these kinds of cases, we're talking about what is the potential price movement of the underlying asset over the next few weeks. So when you're looking at these numbers, they're in percentages. So a volatility of 12% means that there is a price potential of 12% up or down in that particular instrument over some period of time. And you can see really clearly here that that statistical volatility goes up and down quite a bit depending on the volatility of the underlying asset. And that can be really, really useful. If you're looking at, for example, an option chain and you want to buy a call, and the call volatility of that IBM option is, let's say, 30%, you could come in here and say, look, the statistical volatility is only 12%. So the price potential is about 12% over the next few weeks, but I'm paying for a price potential of 30% over the next few weeks. So that option is very expensive compared to what the statistical volatility is telling us. There's a couple of interesting behaviors in statistical volatility. It's very sensitive to gaps. So you'll notice that whenever there's a gap in the market, the standard deviation calculation really jumps up or down based on that gap. And so that's something to think about. So I mentioned the VIX earlier, and I just wanted to bring up this chart of the VIX. The VIX is the chart at the bottom. It's red. Obviously, we're having some really interesting price action over the last few days. And if you look at the VIX over the last few days, you'll notice that we've had some spikes. I've drawn two horizontal lines on the VIX graph here at some historical support and resistance levels. 20 has always been a really strong resistance level. Usually if that breaks, that means the market is broken somehow, and we're usually going to see lower prices. 15 has been also a very strong support or resistance level over the last couple of years. And you'll notice that we had long periods of really quiet markets over the last couple of years, and then this year at the beginning of the year we had that spike in February, and then it's kind of settled down, and now we're having another spike right now. We'll look at this chart in real time here in a minute. This is a multi-data chart in TradeStation. I have the S&P 500, the SPY ETF in data 1, and I have the VIX in data 2. And VIX is just a data stream. So basically I can have 2 data streams in the same chart. So this multi-data chart makes it really easy for me to compare the 2 symbols. Again, one of the important things you'll notice here right away is that VIX and the S&P are oppositely correlated. I'm sure you've heard that before. And if you look, I've drawn some horizontal lines on the chart at key bottoms in the market when VIX is at key highs. So when VIX is high or moving forward, usually the S&P is moving down, and when VIX is quiet or becoming less volatile, values are going down. Usually that's when the market is moving up. And you can see that pretty clearly here throughout the chart. The little spikes in VIX at the bottom usually correlate to a pullback in the S&P, and the S&P keeps going. Another thing I want to mention right now is when we go to TradeStation, I'm going to show you these charts live so we can kind of see what's going on right now today. But also I have provided all of these workspaces that I'm going to show you as part of this presentation. They're at the top of the chat. If you want to scroll up to the chat real quick, you can download the workspaces and the ELD file with some of the custom easy language that I'm going to show you today. You can also find them in the bottom right hand corner. There's a little file folder, and in that file folder you can find the ELD file for the custom easy language, and you can find the workspaces. We'll talk more about that here in a minute. So VIX is the implied volatility of a subset of options for the S&P 500 going back historically. I think right now TradeStation has that data going back on daily data going back 20 years or more. But early on, when we became a broker and we were developing OptionStation, we thought it would be really great if we had a VIX number for every optionable stock. So we would have a VIX number for IBM and for Microsoft and GE and every single stock that trades options. And so we built that into our back end so that you can bring up a implied volatility with the same calculation as VIX for any optionable stock, so that you can then compare the implied volatility of an individual option with that historical norm for that particular stock. That's a really powerful feature in TradeStation. And there's an indicator in TradeStation called implied volatility. Now that's not the indicator that I have applied to this chart. I have another indicator applied to this chart, which is my implied volatility compare, which I'm going to show you here in a moment. But right now it's just showing the implied volatility. And you'll notice that I've put some numbers on the chart. Those numbers are related to earnings reports. And you'll notice that volatility, implied volatility of the options now tend to be quiet in between these earnings events. So earnings events typically lead to higher options, and then you see there's the earnings event occurs, and then the volatility calms down, and then it goes back up again, and this is a very similar cycle for all stocks. Once we have our statistical volatility, and we now can calculate an implied volatility for every optionable stock, we can compare those two values. So this is the indicator that I'm going to provide for you, and basically it's a comparison between the implied volatility, the VIX number for a particular stock, and then the statistical calculation, so you can see them in one indicator. So the idea here is that the implied is always red and the statistical is always blue. And so when the statistical is above the implied, then options are underpriced. And when the red line is above the blue line, then the options are overpriced. So here we're getting an indication of whether the options we should be buying options or looking to buy options, or whether we should be selling or writing options. And so this is a great tool for that, and you can look at any optionable stock and very quickly determine where the implied volatility is for the options for that symbol and where the statistical volatility is for that same symbol. And that can be really powerful. What's even more powerful is you can take that concept, drop it into Radar Screen, and then see at a glance on a list of symbols which of those symbols have, let's say, the highest ratio between the statistical volatility and the implied volatility. So we might be looking for stocks that are really, really, really overpriced and those stocks that are really, really underpriced. And so in Radar Screen, that same indicator is applied here. The gold numbers that you see in those columns, that's the ratio between the implied volatility and the statistical volatility. So when that's positive, then the options are overpriced. And when that number is negative, they're underpriced. And by sorting on that column, you can very quickly find the ones that are most overpriced or most underpriced on a list of optionable stocks. And again, I'll show you that live here in just a second. But to be honest with you, I don't look at statistical volatility that much anymore in my options trading. I tend to focus just on the implied volatility because there's a lot of great information that we can derive just from that data. A lot of options traders look at implied volatility in percentiles. In other words, show me all the stocks where the volatility is in the 90 or higher percentile, because those are options that I want to write. And show me all the stocks where the implied volatility for the options are in the 10% or lower percentile. So those are options that I might consider buying. And so I wanted to create an indicator that allowed me to do that kind of analysis, and that's this indicator here. The red line again is the implied volatility for IBM, so that we get a VIX number for IBM. That's the red number. And then you'll see that there's the highest and lowest value. Those are those kind of horizontal lines here in purple and blue at the bottom. And that's the high and low of the implied volatility over the last 126 days. So that's about 6 months. And then the blue line running through the graph there is the average. And that's a 126-day average of the implied volatility. There's no way to really display percentile here unless the indicator was just dedicated to that. So I didn't do that here. I wanted to see the raw values. I wanted to see the average. I wanted to see the high and low. But if you look right here, if you see my mouse, I think you can see my mouse there. What I did is, instead of plotting it in the subgraph, I calculated and display it here. So this is the percentile of the current implied volatility number over some period of time, and you can determine that as an input. So the percentile is a measure of where the price is right now, where the volatility is right now, versus every day over the last 126 days. How many days were higher or lower than it is right now? And this is telling us that out of the 126 days, 85% of the days were below where the market is right now. And that is significant. But what I really look at in my trading is the relationship between the average and where the current implied volatility is. So you'll see the little blue arrows here that I have on the graph. So the distance between where the implied volatility is now and what the average is over the last 126, that is what I look at. So this is the average ratio. I also display that here, and you can see that that's 22%, so it's 22% higher than the average right there. And so that would be another measurement, and I can use both of those, both the percentile and the ratio between the average and where it is right now, as a way of finding opportunities. I can scan for that again in Radar Screen and sort by either the percentile or sort by the ratio between the average and where the implied volatility is right now. I don't think there's a right or wrong answer here, and I know a lot of people who use this for just percentiles, and that's fine. And the next tool I'm going to show you will help you do that. So the dark gold that you see there is the ratio that I look for. So I look for that IV over the average over 126 bars, and I can sort on that column and find those ratios that are either overpriced or underpriced for the trade that I'm thinking about. So by sorting on that column, I can find, based on what I'm looking for, the ratio between the average and the current implied volatility. I can sort on that and find opportunities. But the percentile is here as well. So there's a percentile column, and if you double click on that percentile column, you can sort by that column and find those stocks that are in the highest or lowest percentiles over whatever look back period that you're looking for. Let's take a look at TradeStation. So this is live, and this is the chart that we looked at before. This is VIX down here. This is a workspace. You can see the 3 workspaces at the bottom here that I'll be providing, the custom indicators that I just showed you in the slides. So here you can see we're getting that spike above 20. We had some spikes above 15 the last few days. And so that big spike above 20 today. If you look back historically, that's what I love about this kind of chart. You can look back historically and see what's happened other times that it spiked above 20. Look at how 20 was such a strong resistance level this year. Couldn't really get over 20, except back in February and March and April here. We had that rough period there. But for most of the summer, we couldn't quite get above 20, even on some big pullbacks. But this is a really great chart for comparing what's happening in the major markets with the VIX. And remember, they're oppositely correlated. So this is the live current chart of that. We're comparing the statistical volatility to implied volatility. And you can see that IBM was down quite a bit today. This is down about 7%. You'll notice that statistical volatility is a little bit higher than the implied volatility. That's because the implied volatility for today won't be calculated till tonight. So tomorrow, my guess is we're going to see a huge spike in implied volatility based on today's action. Remember, the implied volatility is always as of the close of the previous day, so you're comparing the previous day volatility to today. Here's that radar screen scan. So I have a sample scan in here. You can see that I've sorted it by the implied volatility over statistical volatility, so I can see those few stocks that are underpriced, and you can see most of these stocks are overpriced. And at the bottom here, you can see the ones that are most overpriced. In fact, IBM right now is the most overpriced, and we'll see that we will see that in our data tomorrow. This is the live implied volatility. This is the indicator that I look at primarily. Again, we can see the big spike in implied volatility here, way above the average. And if I look at that radar screen scan, you can see that I can sort by that ratio to see those that are underpriced or overpriced. And for those of you like the percentile calculation, you can just double click here on percentile and sort this by those stocks in the lower percentile or highest percentile. Airline stocks have been getting crushed lately, probably because of the higher fuel prices. But here you can see that in fact the implied volatility for American Airlines is making a new high. So this is really great data to look at. When you're making a trade, an options trade, there's a lot of moving pieces. You're trying to pick a direction. You're trying to find stocks that fit your price and volatility profile. And here's a set of tools that help you find those kinds of opportunities and to really look at this data historically. We really have some great data in TradeStation around this implied volatility, so you definitely want to take advantage of that. So we've been talking about volatility, so just a quick primer here since I have your attention. So the way we measure volatility in the option Greeks is with Vega. And Vega has some unique properties that I just want you to be aware of and think about when you're looking at the option chain or if you're looking at the Greek calculations. Remember that Vega is the potential change in the option price for every 1% change in volatility. So if the volatility of IBM goes from 30 to 31, Vega is going to tell you how much the option price is going to go up. Vega is always positive for long calls and long puts. So it doesn't matter whether it's a call or put. If you're long the call or long the put, Vega is always positive. It's always a positive number. So if volatility goes up, call prices are going to go up, put prices are going to go up, independent of everything else. Vega, like all time value, moves towards zero as we near expiration. So all options are a diminishing value asset as we get closer to expiration. So all of the different components of time value start moving towards zero as we get closer and closer to expiration. So Vega is on the left, the underlying asset price is along the bottom. Let's say that we're looking at a 69 strike. Notice that at 69, volatility is at its highest Vega value. So at the money options have the highest volatility value for the option price. It's the biggest effect on the option price at the money. And as we move away from the money, volatility has less and less of an effect. Also, as we get near to expiration, notice how volatility has the biggest effect on our option position the farther away it is from the expiration date. And as we get closer and closer to that expiration date, volatility, Vega, starts moving towards zero. So 10 days from expiration, Vega has a much less effect on our option price than when it was 50 days or 30 days away from expiration. So the key takeaways from this event: we want to buy underpriced calls and puts based on our historical analysis. We want to write overpriced covered calls. We want to write puts, and we want to write credit spreads, all with high volatility. High volatility can also be a warning sign that something's coming. If you're not paying attention to dividends or earnings like you should be, volatility will tell you when something like that is about to happen. So as long as you're watching volatility, there's a good chance that you won't get caught unaware of an options or a dividend play. So keep an eye on volatility. Like all of our events, this will be recorded and posted within a couple of days on YouTube and on our website. If you had any trouble downloading any of the materials from the chat, feel free to send me an email. There's our website to find the video in the next couple of days, tradestation.com/university, and check it out. So that's all I have for today. Thanks everybody for attending. I really appreciate it. We have lots of great events coming up throughout the rest of the month. Don't forget that we also offer a full week of masterclass in-person training here at our corporate offices in Florida. It's a full week of platform strategy trading, easy language. If you really want to master TradeStation, all the nuance of TradeStation, consider coming to our masterclass. And that's available. You can find that on the university website as well. Thanks everybody, and I look forward to seeing you at another event. Good luck in your trading. Thank you very much.